Rich, thanks so much, and I always appreciate the opportunity to participate in these, and I appreciate it. So, good afternoon, everyone. Good early afternoon. But let's just jump right in here. See if I can get it to forward. Yeah. What is a marketing plan? Because basically, I'm going to start just talking about marketing plans, kind of what we normally do if you've never been on this webinar before. But marketing plan is a proactive strategy to price your crop before, at, and/or after harvest. Needs to consider a lot of things: financial goals, cash flow, storage capacity, crop insurance, labor, anticipated production, appetite for risk, and price outlook. We try to hit on a lot of those things, but I think that right there tells you that everyone's plan is going to be a little bit different, right? We all have different opportunities on storage capacity and how we manage these things, and so everybody's plan is going to be look a little different. We try to break these things out into two, right? A pre-harvest plan and a post-harvest plan. And we'd like to see folks maybe, for sure, get those things started, say, by January. And typically we'll use January 1 as sort of a pivot point for corn and soybeans. We use October for wheat. And then on the post-harvest plans, we think you ought to be beginning those things September, October for corn, grain, sorghum, soybeans. And then May, June, we ought to be getting those things pulled together for the post-harvest. And then throughout the year, right, because now we've got two different plans going. We've got post-harvest 2023 crop, but we've also got now pre-harvest 2024. So we should have two plans for each one that we're trying to work through the process. So how are we doing with that 2023 crop? Again, here we're starting to get into, the next slide is going to be where I say it's kind of ugly news. But how are we doing? What this chart is I've got is Kansas average cumulative crop marketings. Every year, NASS surveys first purchasers, right? Elevators, ethanol plants, feed yards, anybody who's buying our crops off the farm. And they asked a couple questions. One, how many bushels did you buy, and then what did you pay? And they create two things with this. One, whenever we see these, weighted average price for the U.S., for Kansas, that's where this data comes from. It comes from this survey. But then they also spit out at the end of the year how much of the crop was sold in each one of those marketing months. And so what this is for 2008 through 2022. So it's a 15-year average of the cumulative sales of crops, both corn, soybeans, and wheat. And so just a quick take a look at that. I've got my thing showing here that number one corresponds to September for soybeans and corn. It corresponds to May in wheat. And so typically in the month of September, we'll sell about 10% of all the bushels of corn that's going to be sold. And then for wheat, heck, we're already up to 17% because, obviously it's the harvest year comes a little differently. And so, by the end of June, we've got a lot of wheat harvested, and so that's why we see a larger percent priced there in that very first month. So where are we now? Well, we're right here. We're in month 6 for corn and soybeans, right? We're up here. And so typically what this is telling us that, for most of us, we've got over 80% of our soybeans done. We're only hanging on to maybe 20%. On the corn side, it's a little bit more, about 75%. Wheat, we're in month 9 now. And so typically we've got 90% gone. So the one thing that probably we've got more of on the farm or in the elevator that we still have yet to sell would be corn at about 75%. So again, how's that look? Not very good. I think I shared this last month, but basically what this is just sort of an estimate of trying to get a handle on, where we are as a state as far as post-harvest marketing. And so I kind of start this thing off in November. The average Kansas corn price was $4.84. And from there, I kind of just pivoted out and I say, what are my costs going to be? And so we do two things. I'm looking at on-farm, I'm looking at off-farm. And I've got how we do it there on farm. We're looking at a one-time 1% shrink based on that $4.84 price, and then a 5-cent in and out. It's just going to cost us some money to elevate it again off the farm and get it hauled out. Commercial storage, I'm using 6% per month. And then for both of those, so the orange line would be the commercial, and the green lines would be on farm. I'm also throwing in sort of a low interest and a high interest. So maybe that's kind of good for that person that's got, hey, I've got all my equity. Really, this is more of like, what could I earn? Maybe it's a lower 3.5%, but maybe, if I'm a younger producer, a more aggressive producer, maybe I'm having to pay a little bit higher interest rates now on operating notes. And so, maybe 7% is a more relative number. Either way we look at it, corn, this analysis would suggest that we're anywhere from 80 to 90% underwater on corn storage. And we'll have to listen to Dan and see what he says. I'm starting to lose hope that we're actually ever going to have any chance of getting back. And so obviously I look at this and I say, I think if I'm still hanging on to some corn, I may want to really think about letting it go, right? And the charts for soybeans and wheat are later on in the handout. I'm not going to run through them, but if you want to see what those numbers look like, they're there. So my suggestion or my idea would be let's get rid of this 2023 stop crop. Let's kind of return our attention to 2024, however dismal it may look like, but let's start focusing there instead. But if by chance you're thinking, man, I listened to Dan, I listened to some people, I've got some person that says there's a chance that we could see a price rise or a rally here as we go into spring, you may want to re-own or consider re-owning with options. You could also do that with futures, just get rid of the cash crop, buy a futures contract. But boy, there's a fair amount of risk because you're going to get margin calls if prices go against you. So I'm going to look at a couple different things you could do with options. Why would I do this? And again, I got a lot of question marks there, right? You could sell the cash commodity, consider re-owning with options, maybe. Why? Because we think there's a chance for a rally. Again, if it were me, this is not a recommendation. I wouldn't do it. But if you're thinking about it, here's how the math would look, okay? So again, this is what we're trying to do. We're gonna look at A, it's just simply buying a call. B, implementing what I would call a call spread. Okay, so what do we got to do? I need to set up an account with a commodity futures broker if I don't already have one. And then we're going to ask that person to go in and buy as a call option. Now, the nice thing about a call, when you buy an option, is how much you're going to spend up front. It's your premium plus any fees, commissions. So that's the nice thing about an option. Okay, so that and a couple of things I want to point out there in that column A then. Number one is out-of-pocket cost. 22 cents. And I didn't carry the digits out, but it's basically the option premium, which on Friday was excuse me, for a 430 strike price on a July futures. And at that day, December corn futures closed, or July corn futures closed at 426.25. That call option would be costing me 21.25 cents. So I add another penny to that, and I'm at 22.25. The other thing I've got there is $1,100 is your total out of pocket for a 5,000 bushel contract. The other thing I want to point out is that 452, which is the break-even futures price. Futures, July corn futures would have to rise above 452 to make this alternative break even. And then everything after I get past 452, then that option is actually making you some money. Okay. So those are two things to keep in mind. We'd have to see a rally of 452 to make that alternative A work. Well, what's this alternative B? Implement a call spread. Excuse me. Essentially, that's the same thing. You go out there and you buy that same call option, but in turn, you also sell a call option with the same expiration month to reduce costs. And so we're looking at, and what I looked at in this example was, I'm buying a 430 call and I'm selling a 480. Now I'm spending 21.25 cents, right? 21.25 cents, and then I'm spending, or I'm getting back then 7.5 cents by selling one. Okay, and what that did was reduce my cost. It went from 22 cents down to 16 cents a bushel. My out of pocket is 7.88. So on a 5,000 bushel contract. So that's kind of the nice thing I'm doing there. Now, I'm selling a call option, right? And I'm also buying one. But now if you sell one, right, you might be thinking this, you might be thinking hold the phone, right? If you've never heard that saying, right? If I sell a call option, I'm going to be subject to margin calls. And that is absolutely true. You're also going to need to provide margin money in your hedge account probably, right? Those are both true. right? So, but if futures prices increase beyond that 480, yes, I'm losing money on that call option, but it's being perfectly offset by the gains you're making in that 430. Another way of looking at that is maybe like this, right? So on the left-hand side, I've got futures prices. Here's my 430 call. If you purchased a July call option, it's going to gain in value as futures prices rise past 430. Now, I said our break even was like about 452 because I've got to cover that premium cost. So essentially what I'm trying to do with this alternative is make money right here between that 452 and 480 futures, because once you get past 480, that call you sold is going to be, quote, losing you money. It's going to be costing you, but it's going to be perfectly offset by the gains you make in the 430. Okay, so that's one way of doing a couple things. One, you're lowering that break even, but you are putting a cap. And we're just saying, hey, I think maybe there's a shot here at, maybe a 50-cent rally. Okay, I want to try to collect some of that. That's what this is giving us an opportunity to do. Okay, with that, again, this is not a recommendation. I probably wouldn't do it, but I do want to run through the math. I think we should be turning our attention to pre-harvest corn marketing, pre-harvest soybeans, and pre-harvest wheat. Now, again, regardless of your unique post-harvest strategies, whether you live next to an ethanol plant, whether you've got ample on-farm storage, everybody should have a pre-harvest plan that's basically got a goal of trying to get a better price locked in versus what it's going to be at harvest. And the thing you're going to note is that typically, again, using those cumulative sales, 43% of Kansas corn is actually sold before, at, or during harvest. So it kind of behooves us to create a plan and try to get a better price. And the nice thing is there are opportunities, right? We see some pretty good price rallies in December futures versus where it is at harvest. And again, what this is a chart of CME Group December corn futures. It's a 15-year price index, and it's kind of showing that, end of April, early May, we see a nice little price rally, typically on average. And then we see even a better one in June. So these are good reasons to create a pre-harvest marketing plan. Key things that we always hammer home: we want 3 key parts to this marketing plan. We need to have pricing increments, we want to have pricing targets, and we want to have pricing dates. Increments are essentially just how much each time you're going to sell: 20%, 10%, 5,000 bushels, 100,000 bushels. It depends on your size. The price is your pricing target. What is that price target? What am I looking for? What's going to make me want to sell? And then the pricing date is designed to compel action when or if those price targets aren't reached. Okay, together these things can guide your decisions. They can lead to action and maybe help take some of the emotion out of marketing. 3 other key components, it's so important. Know your cost of production. It's always important to know that. Something else we would suggest is that you always try to learn as much as you can about different marketing tools. Whether you're using options or not, try to better understand how they might work, because there may be a day that you want to try to use them. Third thing, create and work with a marketing team. Very, very easy to be working in an echo chamber where you just believe one thing. It's kind of nice to have some of these other folks that can maybe help offset your thoughts. So let's take a quick look at a sample pre-harvest plan. This is what I call a sample pre-harvest 2024 feed grain plan. Could be applied to corn, could be applied to your grain sorghum. Obviously, I always say buy crop insurance to protect production risk and maximize the price received on bushels sold before at harvest. That's my goals here, right? So we've got the 3 components, right? We've got pricing increments. I want to price 20% first, and then I'll go a second increment of 10%, a third increment of 20%, and a fourth increment of 25%. Altogether, that adds up to 75%. I've got pricing targets, and I'm basing mine off of December futures. So, because again, the difference between your local price and futures is always that basis. So I kind of use that thing that we kind of hear on the radio all the time. We can pull up on our phone real quick and easy. What are futures doing? And we're using $5.65 as my first one, $6.25 for the second, $7 and $7.25. Third thing I've got are pricing dates. We're looking at June 1 and July 20. Okay, so what is this plan doing for me? Well, the plan is essentially designed to price at least 30%, because only the first 2, right? 1 and 2, 20 and 10%, do I have my pricing dates? And those are the things that are going to compel action. if we don't hit the pricing targets. Obviously, if you're watching futures, we have seen futures just go from, January 1, they've been trending down, right? And so we have never hit any of these targets. And in all likelihood, what we're going to be hitting is that June 1 date to take some action. Okay, so that's what we're waiting for. We're waiting for that June seasonal increase, maybe some weather, a little dryness, something's going to pop that market up and give me an opportunity to take a position. Let's see here. One thing I haven't talked about are pricing tools. That's always a difficult thing because everyone's going to have their own, what I call your toolbox, right? Are you willing to use futures? Are you willing to use options? Are you willing to use only cash contracts like a forward cash contract? So it kind of depends on what your toolbox is. But typically that first increment, I sure would recommend, I think Dan would agree, probably those cash-based things. One, they're not going to have any fees. They're not going to have any commissions. They're not going to have any premiums. So that makes them a little bit less costly to take action. So probably a forward cash contract, 20%. And we're looking at 565 December futures or by June 1. If we don't see that price. What about those other ones? Well, probably maybe a mix of cash, futures, or options. And at that point, it just kind of depends on what's in that toolbox and what you feel comfortable using. Last key point on any marketing plan is if you're using those cash marketing alternatives, like a forward cash contract or a hedge to arrive contract, something that's going to commit you to bushels, never price at less than your expected production cost, right? Never. Just take your chances at harvest if that's going to be the case, right? We don't want to pre-price a loss. All right. So where are we at to date? Haven't done anything, have we? Prices have been decreasing. On the wheat side, I want to price 10%. And again, you'll see that if you go and check the plans that we've got in the handout. But we're looking at a target of 750 for July futures. Again, we're a long ways from that. 565 on December corn, and 1325 for that first increment on November soybeans. 2024 pre-harvest marketing looks like we're going to be hitting our date targets and not our price targets. But April 15 is our first time to be looking. Now, or that will be actually trying to take some action regardless. Last thing I want to throw up here is just a quick chart of cost of production. Dan and Rich and Greg Eibendal, I think, is the leader of that group, but they do a great job there at the Ag Manager website, pulling together estimates of cost of production. And so here's their cost of production for multiple crops. I've got dryland corn, I've got irrigated corn, I've got dryland grain sorghum, and dryland soybeans for all those key districts of our state. Obviously, for anybody who's ever put your cost of production together, that, that yield is a big part of that. And so I've got both their target or their break-even price, but then I've got the yield that was part of that. And let's go and take a look at that 458 Southwest Kansas. And I just want to point out that if you take that 458, you take that times 225 bushels, it would tell you then very quickly that their estimate per acre is 1,030. And if you would divide that by, say, 210 bushels, that break-even cost moves up to 491, right? So keep all these numbers in a grain of salt, or take them all with a grain of salt. But I think one of the key things is, those things are achievable, very close. I do want to point out one other thing here. Let's compare that now to where crop insurance is right now. Check the price discovery site, and I think rolling through, it would have been last Friday. December corn was 467. For grain sorghum, it was 468. They have a different formula slightly, but they also base it off of December corn. And on soybeans for Kansas, we're at 1160. So you kind of look at that. Well, given our estimates of cost of production, for a lot of places we can make that. Now, again, these are futures. You've got your own basis, right? That's going to impact what your local cash price would be. So, to me, this is suggesting that it's going to be a bit of a challenge to use crop insurance to lock in a profit. But I think as much as we can, we need to lock in as high of a APH as we can. The last thing I want to touch on here very quickly, I think we had a couple of questions that was part of the registration process. How do you use futures to protect income? How do we integrate futures, options, and crop insurance? I think my 2 cents is that typically while they're all part of your marketing plan, that crop insurance decision and your marketing plan really are a little bit, they move together, but they move parallel. Again, from a crop insurance standpoint, I think we need, you're going to have to play the cards you get. We're going to see a 467 price, possibly a little bit lower here, because this closes out, I think, 29th of February with the last date that'll go into that calculation. So this is an estimate. This is not the final prices, 467, 468, and 1160. They may or may not lock in a profit for you, but what you want to do is lock in as high of APH and lock in as many bushels as you can. And so I think, one of the things we want to look at doing is consider enterprise units, because that lowers your premium and allows you to have a higher buy-up. I would do everything I could to maximize my crop insurance, but that's one decision. You make it, you can move on. Then we have our pre-harvest marketing plan, and we've just kind of run through that. With that, I'm getting ready here to throw it over to Dan. I want to thank everybody for this opportunity. I do have a link in this thing. There was a really nice webinar done by Dr. Ift and Robin Reed that looked at managing risk with ARC, PLC, and SCO. The webinar slides and the recording is at that. And with that, I want to stop sharing and turn this thing over to Dan O'Brien. Thank you all so much.
Thank you for the opportunity to speak with you today. And without doubt, we're in the midst of a grain market that seasonally is sideways and has a propensity to at this point in time not look at anything positive or at least not respond to it, but the market is what it is. So let's go forth and see what we can figure out of it. Okay, so we'll look at some of the basics of where we're going. So you see in terms of short-term weather information, it doesn't look like there are any major planting problems in parts of the Corn Belt. You do see parts of southeast Iowa, parts of northern Illinois with some moisture, parts of South Dakota dry in different parts, up in North Dakota again. But again, we're in late February, heading off into March, probably more concerned in the long run about underlying dry conditions. And it seems that almost yearly we see a situation like this where we don't have fully recharged subsoil moisture. Mark, as we talk about or wonder about where the markets may go, we're just about to enter into the time frame where these type of concerns with regard to planting, crop development, whether we keep having moisture come or not, or if we have too much moisture, all that's just about upon us. We have been watching some international areas, and you can see that these areas that we pointed out, other than also with the exception of South Africa, these are the main crop producing areas in the world. With regard to our dry conditions, you can see we don't have a lot of dry conditions there in North America relative to this situation in South America. Now, in North America, up into Canada and such, they have some dry conditions in different spots that could affect their wheat, canola crops. So that's something to keep an eye on. So we wonder about what factors that will come in and affect the markets. On March 8th, there's another WASDE report. The USDA did begin to take the initial steps to lower the Brazilian corn and soybean crop. There have been concerns with hot, dry weather late season in Argentina also to deal with. So far, the markets have sort of brushed those aside, the futures markets. It's a fair question as to what we'll see. The in-country equivalents to USDA, and for instance, in Brazil, that'd be CONAB. They've shown production declines, sizable ones for both corn and soybeans, markedly lower than where the USDA is at. And so I think it's a question of is the USDA right, or are the folks in country right? And when you look at the world supply demand balances, we're not sitting that far above the above areas of excess that those declines wouldn't come in and have a positive on the market. I'll give my own opinion on that later on. You might note up in Europe, one thing you don't see is dryness in this. A lot of dryness in the Russia Black Sea area, and again, we've got a lot of wheat coming out of that part of the world, basically flooding the world market at low prices, competing very strongly with what the U.S. would put out on a competitive basis. So that just is the reality of it. Probably the major issue holding down wheat prices at this time, and no major drought showing up in India and China at this time. If anything, probably worries about too much moisture. But so we watch that to see what especially China is and with their predominant buying position may do, and then you've got Western Australia being pretty dry, pretty good conditions in the east. A big issue, and we're not talking a lot about weather today, is the status of El Nino, and whether we have seemingly we have a weak El Nino. There's fears, thoughts of heading back into more of a La Nina condition, and the patterns for that historically have been noteworthy in that they've been really dry. So brought a lot of dryness to crop production areas in the world. So I guess here it's February, not a lot going on. We look out, we have pretty good weather, almost too good a weather, and it doesn't surprise me seasonally that the markets tend to kind of drift and look for direction in February so often. But we're coming into March, April, May, June. There'll be more questions on the South American crop production. They'll be answered, I think, successively in these USDA reports, and from there we'll move on. Feed grain markets, without doubt, Mark, what you said right on in terms of the longer term decline we've been seeing. This is the March contract, so this would be the primary old crop contract that I added in a technical indicator down at the bottom there. It's called relative strength index, and when a relative strength index gets above 75, with 50% being neutral, above 75 heading for 100, then that's a time of great bullishness in the market. You can come back here and actually see how that affected things back here in last year during June. High RSI, and gosh, you see what happened. Since that time, during these times, we've been sort of moderate, etc. Then of late, fallen off strongly down into below 25% and into basically breaking below $4 now. Carry for old crop storage, the market is showing some. After you get past the initial losses, I think, Mark, that's what you were talking about. That 19 cents per month loss is in March futures is basically a total of about 38 cents down from where the DEES contract closed. So you're starting off on the negative side. If you do see carry in the market as it tries to push supplies out on down the road, almost from March to May, and again March going into closure, into delivery here in just a few days. So you do have about 7 cents a month carry there, and about 6.4, 6.5 from there on, 4 thereafter. If we were just starting March 1st, these would be great carries, but it's that first set of losses that we're wondering about. We've been tracking this. We looked at this last time out when we met about a month ago, and looking at kind of the range that we have seen grain prices in, as we've but in essence since the ethanol growth time frame that happened in late 2006. and we've ranged on the low side at $3, on the high side about $4.75, and about $4. They're at pretty much in the middle. Now there have been times of really short crops and other economic factors affecting us. 2007, 2008, we were tight supply wise. Heading into the drought of 2012, then we had the drought of 2012, and then we had to recover from the drought of 2012. Came down off of that, and then again trade issues, relatively short corn crop, etc. Come down off of that now. So now we're finding ourselves having come off of this time frame where we were way above 475. Expectations geared towards that, $6, $7.50, and now we've come back down into the place where on this monthly chart listing the last price, and this will be updated here short at the end of the day, about 414, and we'd seen the March contract actually close at below 4. So in essence, we find ourselves back down at just about the long-term, middle of the road average of $4. And cash prices have reflected it. Here across the state, we pick out these locations and try to follow them. Colby, Salina, Topeka, Garden City, Hutchinson, Columbus, again, trying to have a western locations, central, eastern locations, and really a couple locations. Garden City peaking over $4 at 415, pardon me, 414, 19 over basis. Hutchinson, pretty decent price, 406. Colby, 405, and then other locations below 4. You do see some new crop harvest prices that are well, they're all still above 4, and these are the top prices in those areas. But Mark, I really appreciate that those cost of production numbers that you'd shown. We're at, near, slightly above cost of production, depending on basically having decent yields. You look at grain sorghum, we have some pretty strong export oriented areas that show pretty good grain sorghum prices still. Hutchinson in particular, and you can see that both the top spot cash bid 451, at least 25 cents, 26 cents higher than anything else cash wise. New crop bid 446, again about 25 cents over anything else. So Hutchinson, center for exports. We have pretty strong grain sorghum exports, and Salina not too far behind. Otherwise, we're showing lesser bids. I think it's really important to understand where the markets are at, why we're here. You've seen this chart before from earlier meetings, and basically shows the positions of speculative traders, or we call them managed money traders. And you can see now that the bearishness of those traders in terms of the quantity of short sell positions that they're in, that's the red lines. And over here on the side, if this is in millions of bushels, this is 100 million, 1,000 million bushels. So that's a billion bushels, 2 billion, heading towards 3. We've broken below 2 billion bushels bearishness, and this is as of February the 20th, and not the record amount, but the only other time we have since 2012, actually going back to 2006, I have the data on, was back in 2019. So we have this cascading bearishness in the market, and whether or not I think it's justified is not anything that the market probably is paying attention to. I personally think that there are factors both in terms of domestic production and in South America that have to be looked at that the market isn't paying much attention to right now, and it's strongly bearish. So Mark, I don't know that when I see this, and if I try to think the way that future traders are, it's pretty bearish, but we're gonna have to roll out of the March contract here within the next week into the May. Some of that's already happened, and then start to worry about U.S. trade. We'll get more information on what's actually happening down South America, and then I guess I think there's information coming that this market will have to deal with, that because we're in February, it has the luxury of just putting aside. And normally, when you look at the last 24 years, going back to 1999, 2000 marketing year, and we normally come in to February and you see a pretty narrow band from again for February 100. We have typically been at about 100, little over 100% of the season average price. Pretty narrow range of trades, sometimes a little higher or lower than that. From here, we tend to go to from February a little bit higher into March, April, May, June, dealing with all of this production uncertainty and domestically and somehow South America as well. So that's our typical pattern, and you can see the maximum highs that come as a percent of season average prices, and on the low side. So there's risk opportunity both ways, and
Hey, Dan.
and then yeah.
Hey, the previous slide with managed money, just a quick, I guess I'd love your assessment on this. Given that historical level of just, I don't want to call it overselling, but being way sold, I mean, does that just almost shout at us that, okay, at some point, these people are going to jump back into the market a little bit, and regardless of what's going on in South America, it's going to have to create some purchasing pressure and move this market up. The question, and I guess I'm making that as a statement, if that's the case, then, how much? I mean, could that pop at 50 cents, 30 cents?
Well, to me, it's you're actually holding my feet to the fire, Mark, to actually give a number. But I hear what you're saying, though. I've been surprised that we haven't had more, for all these short positions, they have to buy their way back out eventually. And they're on with algorithm trading, etc. It's easy to stay on the trend. Right now we're on the trend. Hop on the train. We're going lower, but eventually we have to roll out of that March contract into May. We'll have to start dealing with other sets of issues and go from there. I really think that the issued, but then, and when cash marketers talk about this market and they see what the futures are doing, they see these positions, and they state, well, there's no shortage of grain showing up out in the country, and when you go back and you look at Kansas basis levels, we've got Kansas corn basis levels reflecting that, hey, nobody's been forced to come to at least grain elevators to bid up to get hold of grain. So I think the thing to watch is frankly basis levels here and all over the country. It's as long as basis doesn't have to respond, we don't have to bid up to bring grain out of people's hands. Then those that have a bearish sentiment, they're content to stay there. Well, why get excited? There's nothing happening out in the cash market where the real signals would be going on. So that'd be my take. And when we do go to the higher side, another thing to look at, so you see this chart, and when we're even this other time when we got pretty bearish. So that was out in the spring, looks like March, April, May. This is back in 2019. They don't stay forever. Issues tend to come along. You see some that do stay bearish for a while. So I guess I think that I'm hesitant to say X amount of cents to the higher side, but I'm also quite hesitant to say that this situation can endure without users having to come into the market to buy grain, to run ethanol plants, feed livestock, do whatever, and bid it out of farmers' hands to do it, and not see this situation have to change some. Is that getting at that sum, Mark?
Well, yeah, I think so. And I tell you, I just kind of wonder though, let's say on the post-harvest side, right? I've got 80% of my corn sold, so I'm pretty much totally out of this market. I've just got a little bit. But I look at this and I think, well, my gosh, what about if I would re-own with a call, a purchase call, but instead of going in there and grabbing that the money for 21 cents, I grab the 480 for 7 cents and just say, okay, and now I'm re-owning some of my crop on the board. And if we see this thing straighten out and we see a 30-cent pop, in all likelihood, that put is going to gain in value, or that call would gain in value. And that would give me that would be my way of trying to participate in any potential rally from today on.
And Mark, I'd even go back to your 15-year chart you were showing earlier, and it showed during February, March, even into pardon me, part of April, that really a pretty docile market, a little bit sideways to higher. When did surprises tend to come? Late April, May, and June. So if people are holding old crop grain, that's probably their mode. They'll probably hold old crop grain until they get busy in the fields and don't have time to mess with it much. But and that's quite typical. The market runs out of whatever supplies it had bought at harvest, and then there's the demand that comes. So I guess just to be honest, I think we have an oversold situation, and no news to change it, ignoring of news that probably should be given more attention. We have dates out there to look for. Of course, we talked about the March 8th WASDE report. We have at the end of March, we'll have a prospective plantings report. That'll be important. So there are dates where the market will have to pay attention to this. And so anyway, well, let's go on. Let's take a look at this. So there's a typical situation, and here and now you see where the futures are at. The futures at this point, there's that same typical seasonal pattern, and the futures show some carry, but as a percent of the season average price, we're tending towards the lower side of the typical movements that we see. It doesn't seem to me that this market is pricing any production risk in the U.S. in this at all. That's my, and you have to be careful, because people take this information and they take it into account on this and other information in terms of their marketing. But the futures right now seem to be underrepresenting the type of risk that we'll have to deal with down the road domestically, much less out of South America. I would say I was at the USDA Outlook Forum this year, got to go. It's a good experience. The USDA basically lowered their, looking only at the soybean to corn price ratio and other factors too, but mainly soybean corn price ratio being 2.4, 2.5, thereabouts, basically gave a projection of corn acres being down about 3.6 million acres, soybean acres being up about 3.9. And that could happen. I just remember last year on June 30th, when the acreage report came out, to where we were heading in this direction also, and then saw increases in corn, cutbacks in soybeans. So we'll see where it plays out, but at least this is the initial thought of where acreages would go. Sorghum acreage projected to be slightly lower, but again, a lot of planting and field work and weather to deal with before we know that for sure. The USDA, with their projections that have come out, they plugged in long-term trendline yields of 181 bushels an acre for corn. And the highest we ever had was last year, 177.3. That number didn't come. That number was 175 bushels per acre in the by the USDA. And in their last reports, they cut back harvested acres, and had an impact on what that number was. So my own thoughts are that in Iowa, in Illinois, Indiana, southern Minnesota, we get 200 bushel an acre. But as you look at the whole corn belt, we've had a hard time getting over 176, 177. So I see this 181, and it comes in at 15.3 billion. Well, it's still over 15 billion bushels. But I think it's good to plug in the 181, see at that. But I think you also go in, you plug in the 177.3, the highest we've ever had, and to see what that does also. And in the interest of time, I need to move. I'm going to move quickly through some things. Just wanted to show you fast. Corn exports doing okay, but not leading the way in terms of pricing. Grain sorghum exports, these two lines that are higher than our current mode were back in 2015, 14, 15, 15, 16, the glory days of U.S. grain sorghum exports to China. So we're really having a pretty strong U.S. grain sorghum export trend right now. That really the one ag commodity that's really a bright spot. That and soft red winter wheat has been doing well. USDA's projection with that 181 bushels an acre, 17.5%, 17.2% stocks to use, ending stocks jumping 2.5 billion bushels. So it is what it is. You plug that in, there's that 17.2 again, and that takes prices down to 440. So again, that's a large crop, record U.S. yield scenario. And that's I think what the USDA views as their function, coming as that those first sets of numbers coming out to show you what full production is. We get full production, 4 bushels per acre, almost record high yield. That's what you get, 440 by their calculations. There's some other things to consider. So I've got some other scenarios here for old crop, and also for new crop. And in essence, you look at this, 70% chance, 70% likelihood, the USDA is probably right. But there's not a trifling likelihood that these problems down South America that would cut back their production would have a carryover impact on U.S. ethanol, U.S. exports. And so you've got a scenario of, you run through the math, crunch the numbers, look at the price relationships. USDA is projecting 480. If you have something like this, 30% chance, 530. So Mark, that would be what I'd come back and look at in terms of what you're looking at for old crop marketing. So same, there's 35% chance of something coming along and being that hand grenade that you were talking about that would change things. New crop, there's the 181. The USDA plugged in not the 177, but 176, and that's about where we've been. And I'm saying there's about my own judgment, about a 1/3 chance the USDA is right on that high record yield, never been there before. About a 2/3 chance that they're not, and it's a difference. It's about a 60 cent per bushel, about a 3% differential in terms of ending stocks, and we'd still be above 2 billion, but it wouldn't be 2.5. It'd be 2.1, and you can see how that works out. In the interest of time, let me move along here. We want to respect everybody's time. I'll hit the high points here. Brazil. So this is the number that we're watching. The USDA's projection of 124 million metric tons this year. That was down about 2 in the January report. In-country numbers, CONAB coming in at 6, 7, 8 million metric ton less than that. So we'll see who's right. Argentina, prospects for a strong crop. They've turned dry at the end of their year. 1 or 2 or 3 million metric tons off of this could be pretty wouldn't be out of the realm of possibility. and you've already talked about that. So let's hit the high points. Soybeans, downward trend. You look at this, gosh, same bouncing along at 25 RSI, 25 rating on RSI, and pretty similar. Again, the downward trend. It's what's thought provoking is that the trends. You just change the scale, the trends look the same. They're almost mirrors of each other, and not a lot of carry those first 2 months for soybean storage. You add those two together, you're from where we were when the November contract was done, was at 58 cents down. There's some small carry going forward, but even that gives way out in the middle of the summer. Soybean prices, again, pretty similar to corn in terms of where we're at historically. And so we've come down at 1136 and 3/4. And if 1185 is kind of a self-selected on my part, top end of the trading range of where we've been when we weren't really in high price situations, well, we're down into that right now. Prices, tens, there is in Hutchinson 1114, again, pretty strong export influence there, of course. Processors not far away, so you see that. And note here, you look at the new crop soybean to corn price ratios, 2.5 plus in Salina, Topeka, 2.5 plus, that's 2.6, Hutchinson, Columbus. The only place in the state where basically neutral is in Garden City, and that neutral is 2.3, and that's corn country. So that's thought provoking. That's the new crop bid. Spot bids are still soybean bids are still higher. Here's that same chart again, Mark. Kind of look at this. Same bearishness, if not more pronounced, really, for soybeans in terms of what the quantities are different. So you're at about 900 million bushels of sold positions, with the long positions having declined some. And you can see that as this has grown, the decline we've seen in prices. So pretty similar situation. We have been worse again out there in 2019 when we were pretty bearish. Normal patterns, if someone still has soybeans, and I'm not sure how many soybeans are still around. I wouldn't doubt they were. Hopefully people were fortunate and sold early rather than to have endured what's come down here. But for old crop sales, from February, again, similar seasonal pattern, a crop production uncertainty. As we go forward, you bring the futures in, and we're, again, the current futures representing the very low end, out the low end of the type of seasonality we've tended to see. Pretty flat prices down to these areas. And Mark, we talk about where the futures, where down the line markets are going. Markets right now are just not representing any production uncertainty or any uncertainty really. And we're very myopic. We see what we have in hand. Tomorrow will take care of itself, and that's really our mode at the moment. Acres, there's the acreage increase that USDA projected for this year. Again, from 83.6 in 2023 up to 87.5 in 2024. Again, we'll see what corn planting does. We'll see where prices are at when people, for those last few million acres, if that influences where things are going as farmers vote with their planters. Okay, there's a 52 bushel per acre, not the app. Well, I think that's an absolute record high. Again, not quite as out the top as we'd seen for corn, but 52 bushels an acre, large crop. But we've been pretty close to that before. Exports, okay, as a trend. You really see here in these last 4 marketing years, and we talked about this at length before, as you see U.S. soybean crush in these marketing years moving higher and higher, projected to move even higher. biodiesel, part of that. Soybean meal also. The USDA did project a jump up in U.S. Soybean exports, but that remains to be seen. That's going to depend on what happens in South America, and as well as China's willingness to buy. So just quickly then, with those numbers, record high yield, strong acres, you can see the projection. Basically saying for the USDA, I think they're about 70% right for this too, but I'm thinking they're about 40% that they're right for this because there's just a lot that will happen still, up to almost 10% stocks to use, over 400 million ending stocks. And with that, they're projecting prices from this year, 1265 down to 1120. My own opinion is that I think there's more again than a trifling chance South American production is going to come in and impact us. I've got ethanol there. I meant to say crush, etc. Domestic. I didn't down the thing to pay attention to here because I don't have this right up to the high side. Domestic crush up 50 million bushels, exports up 75, total use up 125, stocks down 125 and 315 down to that. Ending stocks, you've 760. If you take the 760 and you have this surge of usage of use in the last part of the marketing year, you're below 5%, and it's about $1.85 difference on the prices. So I guess I believe there's something that's happened in South America, and that their numbers, even at the USDA's levels, will have to come down. And how will the market react when there just aren't supplies there? Would say also for new crop, I see the USDA is 52. If I just take it down to 50, 2 bushels per acre off, which is more of an average number, then instead of 435 million bushels, you're down to 263, down to 6% stocks to use. Instead of 1120, you're closer to 1350. So I'm not trying to just be a contrarian, but you just have to realize that the numbers that we have right now to work with are large crop numbers, and they're conservative, and that's where they come in at. Okay. So I know we're at the end of our time here. Let's I'll do wheat for anybody that wants to stay around, and we'll get that. We'll do it real quickly. Same story. Again, take a look at these charts. They all look a lot the same, don't they, in terms of the downtrends? The soybean one was more extreme, but you can see we're down close to, on yesterday's close, 568 and 3/4 on the March contract. Again, that's going to be going off. See, this is for wheat, hardwood winter wheat. As that market has fallen off, you've got negative carries all the way out to August. So, Mark, if we're still holding wheat, there's less evidence of positiveness than there is on the other commodities. Once we get past that, get in from July to September, then we've got some 5, 6, almost 7 cents per bushel per month carries in that market. But on the way there, not much right now. Wheat has gotten further into the moderate area. If 550 was kind of the middle of the no excitement trading range, we're at 570. We were at 571 in the monthly chart, so we're basically back to neutral. Cash bids, a lot of variability around the state. Out to the west, 496 low, that'd be in the Colby area as the high price, but 555 in Hutchinson, Topeka 546, 551 Salina. There we go. And for if we want to ask the question, is it profitable now, or will it be profitable to feed wheat? Generally, we're looking at a ratio of about 106% 1% or 1.06. And you look at the places out to the west where it would be happening, especially in Garden City, we're still above those levels, particularly for new crop. A 1.11, 1.06 would be where we get at. So we're above it, but we're within shouting distance of at least that ad hoc rule of thumb coming into play. There's the wheat futures chart, and in terms of traders, like bearish. Also, again, if you want to see a really bearish chart like this, hard red spring wheats, just exceedingly bearish. I don't have the right adjectives to explain it, but as those prices have come down, we've turned bearish on wheat, and of course, low exports really have affected the thoughts of folks. Here's the typically what we'd see from February, March, and April. Really not a lot of movement, some variability as you go forth, and the red line current futures they're projected to go down as we'd seen earlier and stay down there. You do have a little bit of gain projected for next year's prices, but they're all, again, that average price for next year, 556. So a lot of pessimism right now in the wheat market. We talked about the hard red plantings. You can see we're 24 million acres projected to be planted. Hard red exports. This is our deal here in Kansas. Well, our exports of hard red we're tangibly, painfully below anywhere we've been since at least 2015-16, and you can blame that on a bunch of things. Higher transportation costs overseas are one, higher currencies are the other. Strong competition out of the Black Sea region is probably the main one, and we're just suffering to find a profitable situation to sell much hard red winter wheat in compared to past years. So let's take a look. USDA's projection for prices, if they were 720 this year, to continue lower down to 6 as a average, stocks to use up to 40%, and I don't have a lot different to offer. There is one situation where we have lower yields coming in at say 46 bushels per acre for this year. You can see the 46 right there, and you end up with lower production. 2.5 billion instead of 2.6, almost 2.7. You run that through, you're down to 635 ending stocks, 33% stocks to use, about where we had been when we had better prices, and then you're at 8. But that's like a 1 in 4 chance. When you're look at the other situations of even higher production and just piling on ending stocks up to get even higher than we are, then we don't see a lot positive on the wheat. And we're not against wheat, but that I think the best, it's not a good thing that would happen, but if there was any type of a production shortfall in the Black Sea region that held back that torrent of supplies coming out, particularly out of Russia, that would probably be the biggest thing that could affect the U.S. wheat market, just because of giving us a space to sell competitively into. It just is the reality of it. So last thing on wheat, take note, we're bearish as all get out in the cash market, and it's like we're talking out of both sides of our mouth at the same time. Note the world minus China ending stocks declining, 16-year low. Stocks to use looks like this right here, lowest 19, below 20%, lowest since 2007. Sometime out here we won't be able to buy wheat hand to mouth from the Black Sea or wherever who's trying to fire sale their wheat out into markets. Someday we'll have a shortfall there. The world will look around and they'll say, you know what? I guess we don't have very many stocks around. and at that time, you're set up to have a very volatile, explosive wheat market. But right now we're myopic. We don't have to think about that, and we're not until it happens. So Mark, at that time, if we were somehow, I think there's a word called prescient. If we had enough foreknowledge to know when that was going to happen, then your call options would make a bunch of money. But until then we're not paying attention to any of this. It's just not in our thinking, and we're just paying attention to, hey, there's cheap wheat to buy right now, and that is what it is. Well, hey, we've gone past our time. Sorry about that. Any other questions that people have? Anything in the chat that I need to try to address?
We don't have anything right now, Dan. Folks, go ahead if you do have any questions for Dan or for Mark. Be glad to have them.
I'll tell you, the only thing I would add here would be, you know, Dan, on your tables, your supply demand tables, both for corn, soybeans, and the wheat, you always throw in that furthest to the right where it's a lower yield. But to your point, it is just tiny. And so, you know, I guess I feel like, you know, as we start trying to implement our pre-harvest plans, I don't want to say I'm encouraged, but you take that overall stocks and the fact that we are so oversold, it just kind of, I don't want to say, like I said, I don't want to say it gives me the confidence, but you know, I think there is some good odds that we're going to see a bounce up and give us some opportunities to maybe make some pre-harvest sales.
Mark, you and I and Rich have heard the saying in economics so much. It's easy to predict the trend. It's difficult to project the turning point. That's right now we're in February. It's the trend is where people are staying. If there's a turning point to come, those factors will show up, you know, in spring and early summer. I'm thinking, because that's when we'll have the uncertainty coming in.
Dan, we did have a question in the chat there. I don't know if you have it open.
Okay, let me pull that up.
Old crop corn basis.
Old crop. Oh, I didn't pull it up here. I've been looking at our Ag Manager website, and Rich maintains basis charts for a lot of the major elevators in the area, and almost every one of them has either the low right now have the lowest, weakest corn basis, or tangibly separating out to the low side, or are tied with it. A little more strength maybe in South Central Kansas, but everything else tangibly lower. So my thoughts on old crop corn basis heading into the summer are that I don't want to just use any more hyperbole than I already do, but I think that'll be the signal of how on the demand side we're having to come and get some corn. The weakness we see right now is just indicative of nobody having to go bid up anything. I guess that we call it a buyer's. Right now it's a buyer's market, because it's cheap, but when these people do have to come to the market and try to pull grain out of people's hands, corn especially, they'll have, if the futures are still going level, then they'll have to increase their local bids, and I think frankly that'll probably be the first signal of a turnaround in these grain markets, that local bids will have to show up. So that's my thought on old crop basis. They're lethargic right now at best, but assuming someday people are going to have to come and buy corn that's in storage, I don't see how it can stay that way.
I just toss out there that, if you look at December 1 stocks of corn in the state of Kansas, we were at about 26% of production. So we had a little bit more, because normally we'll have about 23. So we had a little bit more on farm this year that would be, quote, available to sell, which could kind of weigh on basis a bit. The other concern I've got is and I don't follow up enough, but what is the impact of declining cattle on feed numbers What's that going to do to say corn demand, especially here in Kansas, and our ability to want to pull it out of the country? You know, like I said, December 1, we were a little bit more on the farm, or a little bit more, on farm than normal. And then on top of that, we've got fewer cattle on feed. To me, those are both slightly negatives towards basis. Now, again, I've never put that on any kind of model or anything, but I think those are two things. You know, Dan, what are your thoughts on those two?
Well, from a fundamental point of view, yeah, declining cattle on feed would be a negative in terms of the quantity of corn, the demand for corn bought out here in the West, where the feedlots are largely. So I guess I don't have a lot to say on that. One thing I would like Mark, when we come into these things down the road, I really like that analysis that you'd put together, and where you looked at grain stocks and projected use by quarter. And here we have when we do this in March, we'll just be days away from another one of those quarterly stocks reports. I'd encourage you to update that. That's really kind of market intelligence to me.